Hello, everyone. This is the Free American Press with your host, Alexander. Before we begin, if you can please subscribe to the channel and leave a like, that would be great. And today we have Adrian Day on the show. Adrian Day is the chairman and chief executive officer of Adrian Day Asset Management. The firm was created in 1991 to serve the needs of individuals, families, and small institutions who believe in the merits of investing with a global value perspective and with gold serving as an integral part of a risk-averse approach. Hello, Adrian. Thank you for being on the show.
Well, thank you very much for asking me. Good to be here.
That's great. So, what's your big picture outlook for the global economy over the next 12 to 24 months?
How long do we have? um, I mean, that's a pretty big question, a pretty big question. But basically, I think that there's a couple of things going on. So one would be the growth, and I think growth could well continue, but at a sluggish pace. China's economy is slowing, but it's still growing, but the rate of growth is down. And I think it's an open question as to which direction China's economy goes in. But the US economy, in my mind, is definitely slowing. There's no question about that. And this was apparent, even before the tariffs came in or anything else. So with the US slowing, China then becomes the most important economy to look at after the US. So, so I'm moderately positive on the global economy for the next 12 months. But the other part of it is inflation. Most central banks around the world have been cutting rates before they have inflation under control. Japan is the exception. Not that inflation's under control, but they're raising rates. But pretty much every other major economy and country around the world is reducing rates, and they're doing it before they've cut inflation. And so I think the big risk in the economy in the next, let's say, 18 months would be a meaningful pickup in inflation.
Yeah, that makes sense. Inflation is definitely getting higher, so that makes a lot of sense to me. So, what is driving the renewed interest in gold among global investors?
Well, as you know, it's gold has been moving up for the last 3 years, really, slowly at first, but for the last 3 years. And initially, for the first in 2023 and most of 24, that was really driven almost exclusively by central banks. Central banks wanting to diversify away from the dollar, diversify away from a single currency that represents the majority of their assets, and an asset that is a currency that is the asset of a fiscally irresponsible government, and a government that has taken to weaponizing its power. And so, most recently, of course, and most spectacularly was the confiscation of Russian assets when they invaded Ukraine. But it's really been going on before that. And so you've had central banks wanting to diversify away from that, and that's been going on for some time now. But I think and it's not a coincidence that it stepped up after Russian assets were confiscated. More recently, this year, we've had Chinese non-official, so Chinese retail people have been buying gold aggressively. And those are the two major things. We've seen a little bit of a pickup we've seen a pickup in Western Europe for the last 6 months. And then really just in the last, 2 months, we've begun to see a pickup in the US. And in the US, it's based much more on economic factors. Whereas the Central Bank of Poland buys gold because they're concerned about having a concentration of assets in a single currency. In the US, people tend to buy gold, not as an insurance or protection, but they tend to buy gold when the economic factors are in their favor. And that means a lower dollar, lower interest rates, higher inflation. and perhaps a weakening economy. And I think those things, to different extent, have begun to become apparent in the US. And that's why we're seeing a bit of interest from the US. But the US is by no means, North America is by no means the main driver of gold for the last 3 years, by no means.
Yeah, that's definitely true. I heard my friend in Japan, when gold and silver prices were really getting higher, that he was having a hard time even finding gold in Japan, while America it seems to be easier to buy gold. So you think could you go talk to the viewers a little bit about how other countries are driving the gold prices and which countries those are?
Yeah, well, China's number one without a shadow of a doubt. Now, not only is the Chinese population obviously a lot bigger than other countries around the world, but they're concerned about, Chinese people are concerned about the possible devaluation of the yuan amid the slowing economy, and concern in Japan, in China, a distrust of the banking system, not really wanting to invest in real estate, which has been a traditional hedge for Chinese people, but there've been a lot of spectacular bankruptcies in real estate. And so if they're suspicious of if they think the currency is going to depreciate and they're suspicious of the banking system and they don't like real estate, it really only leaves gold because
Yeah, that's
they're
true.
not allowed to buy in crypto. And so you've seen this huge, I mean, it's been an incredible upswell in gold buying in China. And it's not just retail, it includes retail, but it includes institutions as well. China, of course, has a long history of affiliation with gold. They like gold. And the other thing to understand is that in China, as opposed, and in much of the world, particularly in Asia and the Middle East, people will buy gold jewelry as a way of buying gold. That doesn't really happen in the US. When someone goes to Cartier and buys a gold bracelet, first of all, they're paying like a 400 or 500% markup over the value of the gold. But nobody in America buys gold jewelry because they want to make an investment in gold. They might say, oh, well, your girlfriend or wife will say, oh, buy me this beautiful bracelet. It's gold, so it'll hold its value. But nobody buys gold jewelry as a way to buy gold. But that's different in the Asian countries and in the Middle East, where you have a lot of much more crudely designed jewelry, which is often sold at the price of gold plus a markup. So if you say, I'd like to buy this bracelet or these bracelets, they'll put them on a scale, they'll get the calculator out, and they'll calculate the price of gold, and then they'll add 10% on. So
Hmm.
that's a completely different way of looking at gold jewelry than we do in the US. So you're seeing gold jewelry lines around the jewelry stores in China. But also, as you may know, the Shanghai Gold Exchange has started to make moves to become the dominant gold exchange in the world. So you're seeing it in both institutional and retail. You're also seeing it in much of Asia, in Thailand, in Singapore, and then you're also seeing a lot of gold buying in the Middle East. Those would be the main countries, I think.
Yeah, it definitely makes sense. There's definitely cultural differences between those countries and the United States. So you touched on Shanghai is wanting to become the leader with gold, and that's taking out the LBMA's position. So could you tell the viewers how the Shanghai Exchange is going to do that and how they're going to accomplish that goal?
Oh, well, I'm not really an expert on that, but one of the things that they're certainly doing is trying to encourage, well, first of all, they're bringing their own gold back, and they're trying to encourage other Asian and friendly nations to hold their gold on the Shanghai Exchange rather than in London, or some still have it in New York. So countries that are favorably disposed towards China are moving their gold out of London into Shanghai. And these would be the BRIC countries, for example. So that's the main way that they're doing it. And then they're just one thing leads to another. It's a self-fulfilling prophecy. It becomes because they have more volume, it becomes a much more dynamic market with a narrow spread, and the volumes are good. So now you're even getting a situation where a lot of US traders are using the Shanghai exchange to hedge. If they think gold is going to go up throughout the day, they'll buy in Shanghai and then look to sell in the US if they're correct, and make money that way.
Well, that makes a lot of sense. That makes sense that China would try to get its allies to use the Shanghai Exchange instead of the LBMA. That seems to be a big geopolitical matter. So that leads me to my next question. How much geopolitical risk is currently priced into the gold market?
That's a really good question. When we think of geopolitical risk, most people think of wars or terrorism or something like that. And I think there's a misconception as to just how much, wars and terrorism and other geopolitical events generally move gold. They really don't. If you look back over the last 70 years, more often than not, the effect of a geopolitical incident is it might be a short spike, it might be a spike, but it's very short-lived. And a good example of that would be the Russian invasion of Ukraine. For 3 weeks before the Russian tanks moved across the border, gold was moving up and moving up quite nicely based on concern, based on the massing of the troops at the border and concern that they would invade. Once they invaded, that was actually the peak. And over the next 3 weeks, gold actually gave back everything that it had gained. And that's not unusual. You go back to other geopolitical events. They've been relatively short-lived. But if you're looking, if you're not looking so much at wars and terrorism and actual, violence, but you're looking at shifts in geopolitics, namely the move away from a US unipolar world and the US being the only reserve currency. If you're looking at that, then that has been a major driver of the gold price. It's difficult to quantify how much is priced into gold, but I think it's been the main driver of gold over the last 3 years. Not so much for the Chinese non-official, but for central banks and for Middle East families and so on. And I don't see that going away. I don't see that going away at all. But, when I say things like, I don't mean to be dismissive, but things like, the truce and potential peace in Gaza, that had no effect on the price of gold.
Right, yeah. I definitely think what you said was true. So you touched on Ukraine, you said that was a driver for gold. So we see the US is having a lot of ships in the Caribbean, and it seems like they may be preparing for war with Venezuela. So if that happens, do you think the gold and oil prices are going to surge? And do you think we will go to war with Venezuela in your estimation?
Well, let's do the second part first. I'm not a geopolitical analyst, so it sure looks as though we're gearing up to it, right? It sure looks as though we're gearing up to it. Um, that will have a significant impact on the price of oil because that'll have a fundamental shift on oil. Now, initially, and it depends how things play out, but initially you could see a spike in the oil price because Venezuelan oil will not be available to the global market, and perhaps some facilities will actually be destroyed. You destroy a refinery, you destroy an oil field, you destroy oil tankers. So that would have a fundamental impact on the supply of oil. So that would have an impact on the price of oil, and probably a little long lasting. I mean, it sort of depends on how many of their facilities are destroyed and how the war turns out. If you have the US doing bombing of Caracas and then there's a collapse of Venezuela, and another government is installed, it would only be short term because the oil would come back quickly, and that Venezuelan oil would now be able to be sold directly to the US,
Yeah.
right? So that would actually be a negative for the price of oil. But if you have another scenario where facilities are destroyed and taken offline, that could be, and the war drags out in some way or another, perhaps there's guerrilla activity or whatever. That could actually have a longer lasting impact on the price of oil. Gold, no question that the price of gold would move up in the event of a war. And part of that would be because the oil price is moving up,
Yeah.
right? But I still think that would not be a main driver. It wouldn't be the main driver of gold. So it would be relatively short-lived.
Yeah, that makes sense. Definitely, because these wars can last a long time once they get started. So the initial happening of it will create the biggest move. So switching gears a little bit, what do you think the Fed will do in December about rates, and what will happen to the gold and silver as a result?
Yeah, it's the betting market is 50-50 right now. And I think the betting market is probably correct. So it's 50-50. You've got, I suspect that my own feeling is that unless economic news comes in the next couple of weeks that shows unemployment moving up dramatically, I think the Fed will not cut rates next month. Um, Several reasons, but one reason we could comment on is, if this is Jerome Powell's last meeting as chairman, he probably doesn't want to go out doing what President Trump wants him to do.
Yeah.
He probably wants to just say, well, on my way out, I'll stick it to him. But there's obviously on the Fed right now, there's obviously voices that want to cut and there's voices that don't want to cut. And so having cut in last month, I think the most likely is that they won't cut this month. What will that do to gold? Well, if the market's 50-50 and you don't cut, you are disappointing half of the market or surprising half of the market. So I think there could be a little bit of a reaction to gold, but in gold on the downside. And conversely, if they do cut rates, I think gold will move up. But again, I don't think that's the main driver of gold at the moment. So yeah. I think if the Fed doesn't cut, you'll get a negative reaction, but a mild negative reaction for a short period of time. If they do cut, that's just more fuel to the fire. That the US is not going to be able to control this deficit. The things are getting out of control. So, that will be a positive. But I think a bigger positive, if I may, rather than the interest rate direction, will be what happens to the balance sheet. And as you know, the Fed has QT for the last couple of years, and they've already announced that they're going to end QT on December the 1st. But they're already down to 5 billion a month of runoff on the balance sheet. 5 billion on a almost $7 trillion balance sheet is not a heck of a lot. It sounds like a lot, but I can put it in perspective of a $7 trillion balance sheet. It's not a lot. And not only have they been at 5 billion for the last 6 months or so now, but what they're actually doing now is when the mortgage securities mature, they're taking the proceeds and buying treasuries. And the treasury purchases last week were the highest that they have been for the last, 4 years. So I think QT is effectively over, but it officially ends on December 1. And I think they've already started QE. When they start buying treasuries more aggressively, then that is going to be wildly bullish for gold. Wildly bullish.
Yeah, that definitely makes a lot of sense to me. So, which commodities are most undervalued right now based on the global supply demand trends?
Well, you asked specifically which is most undervalued. If I may, I'll answer a different question first,
Okay.
which is I think gold still has a long way to go. And in my mind, gold has the best risk reward because there are risks to the other commodities that gold doesn't have. So on a risk reward basis, gold is the best. But if you ask the question, which you did, which is the most undervalued, I don't think it's gold. I think other commodities like uranium, copper, and even things like zinc are very undervalued and much more undervalued. Oil and gas, very undervalued. I mean, oil is sort of hated. The sentiment on oil is just so extremely negative, and people imagine that we're not going to be using any hydrocarbons in 10 years' time, which is just nonsense. It's just not going to happen. Even if you want it to happen, it's just not going to happen. So I think the sentiment being so weak, oil oil and gas very attractive right now. But all of these commodities have a risk that gold doesn't, and that is if the Chinese economy slows, they will reduce their purchases of all these base metals and commodities. And China is the number one. China is the number one source of demand for pretty much every commodity out there. And so if China goes away from the copper market or from the oil market, that has a meaningful impact on the prices of those commodities.
Wow, yeah, that makes sense. So, what percentage allocation to gold or commodities makes sense in a balanced portfolio?
Well, look, every investor is different, and everybody has a different risk tolerance. The thing about commodities is that they are extremely volatile. Now, a lot of investors, I would say even most investors, they conflate risk with volatility. Volatility isn't risk. You can have something that's very, very volatile, but low risk. But people conflate the two. And it's not just a matter of your financial risk. What are your obligations? How much savings do you have? Etc. It's also a matter of emotional risk. Some people simply cannot tolerate losses. Some people cannot tolerate extreme volatility. And so for those people, you simply have to have less in the commodities than someone else who's in the same financial position as you, but can tolerate and accept risk. So, but having said all of that, I think that the commodity complex generally is the most attractive asset class out there. It's so undervalued relative to financial assets. You don't want to be in bonds right now, with so much debt in the world. You don't want to be in bonds. Developed stock markets are extremely stretched, extremely overvalued right now by some measures, the most overvalued they have ever been. And gold and commodities are the most undervalued assets out there right now. And if you look at the commodity complex relative to the stock market, whether it's the US stock market or the global stock market, we're trading at essentially 100-year lows. 100-year lows. Doesn't mean it can't get lower, but it just means that things are really weighted in your favor. And so to answer your question, if I have a client that comes to me and can accept risk, is emotionally suited to volatility, they don't mind volatility, they've got income somewhere else or whatever, I'm going to be as high as 50% in commodities. And that would include agriculture and oil and gas. It would include all the commodities. But we'd be as high as 50%, which a lot of people think is, very high. But, I don't. I always ask the question, what else are you going to put it in? Are you going to buy Nvidia at this price?
Yeah, it is pretty high.
So yeah, so it in our accounts at the moment, it is commodities generally of a number one area we have by far.
Yeah, that makes sense. So, switching gears to the stock market, you said the stock market is a bit overvalued as a whole, but are there any stocks that you see that are really good right now?
Yeah, I'll answer that in two ways, if I may. You said any stocks. I certainly think there are markets that are less overvalued and represent good value. The British market right now is quite undervalued. And it's undervalued because, of course, the sentiment on Britain right now is very weak because of the current government just messing everything up. I mean, messing everything, and I mean everything up. And so the sentiment towards Britain is weak. But when you think that most of the better companies in Britain, most of the bigger companies are exporters, the fact that Britain is a mess and the fact that the pound is weak is actually a positive for those companies.
Yeah.
Certainly not a negative. I think Hong Kong stocks are cheap, um, very undervalued. Singapore is very undervalued. Japanese stocks are quite reasonably valued. So there's a lot of markets around the world that I think are relatively good value. And then to answer more specifically on stocks as opposed to markets, we are very, very bottom up focused right now on buying equities, meaning we're looking for really good quality companies, regardless of the market, regardless of the sector, just good companies that are undervalued. And you can always find those. They're more difficult to find in this kind of market environment, but they always exist. Now, in the US, we'd be looking very defensively, generally speaking. So we'd be looking at consumer staples, for example, or utilities, or high-income stocks, which have not done so well over the last 15 years of this bull market, where people don't care about dividends. They don't seem to care about earnings. They just want the forecast of earnings at some point in the future.
Yeah.
So that's where we're finding more value right now. But generally it's a bottom-up approach, and that can be all sorts of things. I mean, we own an entertainment company in Singapore called Kingsmen, which is a great little company. It's only 100 million market cap, but it's a great little company with growth, with a dividend, pays a dividend. And they're doing all sorts of, they're designing all sorts of interactive entertainment for Singapore and for China. So the growth there is very, very strong. In the US, we're buying a company called Ares Capital, which is a business development company, lends money to small private companies. And that's the kind of company that people kind of get nervous of when the economy is weakening. But for various reasons we don't have to get into now, we can if you want, but for various reasons, these companies tend to do well when the economy is a little weak. Not when it's extremely weak, but a little weak. Because companies still want money, right? Private companies still want money. They still want capital, but they can't get it from the banks. And so they go to alternative sources of capital to get the money, which means the BDCs are getting better quality companies, and they can afford to pay, they can afford to demand higher interest rates. So a company like Ares, for example, is yielding 9.5% right now, fully covered by earnings. So a company like that, I think, is good for retired people. I'm not suggesting you buy it, but for people who want income, something like that's good. But we're just seeing value everywhere. I mean, I'll name one more. In England, there's a company called Fever Tree. Some people will know Fever Tree because they make a ginger ale that is the ginger ale of choice of most bartenders in the US. You go to a bar, I've done this with some friends when we're talking about it at dinner. I said, just ask the bartender what ginger ale he uses. 9 times out of 10, they're buying Fever Tree, which is a British company, because they make the best ginger out there. Now, Fever Tree is a British company. They started expanding into the US, which is great because the US is a big market. But the real game changer was when Molson Molson Coors, they took a 10% position in the company. They're now manufacturing it in America, which means you don't have to worry about tariffs anymore. They're manufacturing it in the US. And more importantly, I think they're getting the distribution. So now you're beginning to see it in stores. In the past, you just never saw it in stores unless they were highly, specialized stores. You'd see it in New York, you'd see it in San Francisco, but you wouldn't see it in a normal supermarket. But now with Molson doing the distribution, they're getting into more places. So I think a lot of potential in a company like that. But again, as you can see from the three examples I gave you, there's no overarching theme. We're just looking bottom up at good quality companies that have a story, if you like, a story for growth.
Yeah, that definitely seems to be the smart choice in doing that. And I really like how you like dividend stocks. It always appeared to me that dividend stocks were the best stocks that give a good dividend because you can continue to own the stock and still get paid for it. So,
Absolutely. And my friend, you probably know Doug Casey, do you?
oh yes.
Yeah. Doug rather irreverently pinched a phrase from the Catholic Catechism. He says a company that pays a dividend, he said, a dividend is a bit like an outward sign of inward grace. A company that can afford to pay a dividend consistently is obviously doing something right. So even if you're not buying it for the dividend, right? Even if you're not a dividend type investor, when you buy a company that's paying a dividend consistently, you're buying a company that's clearly generating profits and is doing something right.
Yeah, it shows the company has enough profits to give you money. So,
Exactly.
yeah, and that's really important, I think, rather than a stock that there's a lot of things in business when they just make a company and then they just keep raising more and more money, but there never is really they're not ever really doing anything for their investors. It's kind of almost like a Ponzi scheme, if you will.
Well, sure. And those companies, I think they're called unicorn companies. Those companies depend on more money, more equity raises just in order to keep going and pay back the last equity raise, which is a Ponzi scheme.
Yeah.
Now, sometimes, of course, you have a company like Amazon that at the beginning of their growth profile just needs huge amounts of capital. And so it's years before they make money, but they have an actual business plan. The key is, are they generating cash flow? And if they're generating cash flow and the cash flow is growing, then at some point you can see an end to the need for new equity raises. But other companies, they're just going to be raising money until they go out of business.
Yeah, that's definitely true. And then the investors are going to lose the money that they.
Yeah.
So what's the most overlooked risk in the global markets today?
Oh, Lordy. Um, well, I think generally I would say uh the complacency of investors. Investors are so complacent that they kind of think there is no risk in the stock market in particular. People just think every time the stock market goes down, you buy the dip and it'll always go up. And they think that about real estate as well. And history tells us that's just simply not true. So I think the biggest risk for investors, which is a slightly different question than the one you asked, but the biggest risk for investors is not to be too complacent and to recognize that there is risk, and that might mean always holding some cash in reserve, It might mean, just slowly trimming positions and things that have done well, etc. But the biggest risk in the overlooked risk in the global economy and market, I think the biggest risk, frankly, is that the slowdown we're seeing in the US will lead to a significant global slowdown.
Mhm.
And I don't think people are really expecting that.
Yeah, I think that's true. I think that'll hit a lot of people like a brick wall would. If an investor could only do one thing to protect wealth in the next 2 years, what would that be?
Oh, definitely buy gold.
Okay.
Yeah, definitely buy gold. And I mean, if you're protecting wealth, you want to buy physical gold. If you're wanting to maximize your returns, you want to buy gold stocks. But yeah, to protect wealth, unquestionably buy gold.
That definitely makes sense. So I'd like to take the opportunity now to share your website. I was wondering if you could tell the audience a little more about what you do with your company.
Yeah, thank you very much. I appreciate that. Well, we manage money and we're a little bit different from most money management firms. Number one, we're not, we're prepared to take smaller investors. I mean, it has to make sense, basically. It has to make sense. I mean, you don't want someone saying, here's $1,000, can you manage it for me? But, most money managers these days have $1 million minimums, and we're not like that.
Yeah.
Um, and the second thing I would say is where we're a little bit different is that we will personalize accounts. Most money managers these days manage to a model. What that means is that if you come in, they might have 3 models in their stable. And if you come in and say, I'm a conservative investor and this and that, they put you in model A and they immediately will buy for you everything that's in model A with very little room for, very little wiggle room. We are prepared to be more individual if a person wants tax losses or doesn't want tax losses. Sometimes people will say to me, I don't want any, I don't want any tobacco stocks, for example. Or they might say something like, look, do what you want, but the reason I'm coming to you is because I really want to start moving assets out of the United States. So I want less exposure to the US. So they'll give us a preference. So we're prepared to work with people on an individualizing the portfolio. And the other thing I'll say, just I don't mean to, the other thing is, yeah, we very much believe in everything we do is value. Everything we do is long term. I'm not a trader. Doesn't mean I won't cut my losses if something goes wrong in a short period of time, but we don't buy anything unless we intend to hold it for 3 to 5 years. And sometimes we wind up holding things much longer. In fact, the very first 2 stocks we bought in 1991, Nestle and Franco-Nevada, we still own them. We still own them both.
Do they pay a dividend?
Yeah, Nestle has about a 4% dividend yield right now, and Franco is small. It's about 1%.
Okay.
And now it was more than that 10 years ago, but
Yeah.
the stock's done so well. But it's so, we believe in being value oriented long term. And then the last thing is global. Everything we do is globally oriented. And that some people would say that doesn't sound so different from most people, but it really is. You go to a lot of money managers and they'll give you a global allocation. So it's like 90% is in the US and then we'll give you a 10% global allocation. We don't look at it that way at all. 100% of your account is global, but that might include the US. So at different times, the US will be the largest part of our portfolio, and at different times, we might have virtually nothing in the US. But we're always looking all the way around the world, and we're always comparing, a US company, a Swiss company with a, Brazilian company or a Thai company. Now, obviously, you expect if you're buying a Brazilian company, you expect to buy it at a discount to a US or Swiss company, but we will still compare and see where is the relative value.
Yeah, I think that's definitely smart. And I think you gave a lot of great information here today. I think the people watching this video should definitely check out your website
Thank
and
you.
if looking for investment to possibly invest with you, because I think you gave a pretty good outline on everything and a pretty good way, smart way of investing. And I would just like to thank you, Adrian, for being on the show and providing all your insight on all these topics. And I would just like to thank you and have you on the show again sometime.
Well, thank you so much for asking me. Yeah, I'd love to come back.
Oh, that's great. And I just like to thank you for everyone for watching. Please share this video with your friends and comment and like the video and subscribe. And thanks again for everyone who's watching. Goodbye.